At 9:23 a.m. Beijing time on December 26, 2025, a number printed in Shanghai that made physical dealers stop breathing, $81.99 an ounce. Not a futures quote, not a cash-settled promise, real metal, deliverable today. And at the same moment, New York was flashing $79.57, a $2.42 gap between East and West. A premium so loud it doesn't whisper opportunity. It screams breakage. They want you to believe silver is still one market. They want you to believe the screen is the truth. They want you to believe if you can click buy, the metal exists. That belief is what's about to get destroyed. Because this wasn't a glitch. This wasn't a random spread. This was the first visible crack in the pricing system right before a hard deadline. January 1st, 2026, 4 days. That's the countdown to the moment China turns silver exports from a flow into a permission slip. And once supply becomes permission, the price on your app becomes a suggestion. Welcome back. You're on this channel with me, and in the next few minutes, I'm going to show you what actually happened, why it matters, and why the next 96 hours can rewrite the rules of the silver market for years. Before we go deeper, quick favor, subscribe. One tap. Because the first week of January is going to be disorderly, and you'll want the updates when the headlines lag the reality. Now, rewind 8 weeks, late October of 2025. Silver was already ripping, around $52 an ounce, up hard on the year. Enough to make chart people celebrate. But inside the physical trade, nobody was celebrating. They were counting bars. They were asking lead times. They were checking refiner schedules. Because they saw something the chart can't show you. On October 30th, a short official notice appeared out of China. Starting January 1st, 2026, exports of physical silver would require individual licenses. Not a simple quota, not a blanket tax. Individual approvals. Case by case. Destination by destination. End user by end use. And here's why that matters. Silver is not like a meme stock. It's a supply chain input. It's the atom that makes modern electricity behave. When exports are automatic, industry plans. When exports require permission, industry panics. Because permission can be delayed. Permission can be under review. Permission can be revoked. And that single word, license, changes silver from a commodity into leverage. Most people missed it because they hear China and think mining. But mining isn't the only choke point. Refining is. Refining is where a raw concentrate becomes deliverable bars that factories and mints can actually use. And China is a heavyweight in refining, meaning even if the ore comes from somewhere else, the final deliverable metal often passes through Chinese capacity. That is the hidden artery. That is the real tap. So when the tap moves behind paperwork, the world doesn't just get less silver, the world gets slower silver, uncertain silver, silver that may arrive after your production line has already stopped. When that October notice dropped, the Western reaction was lazy. A little spike, then a shrug. Analysts soothed everyone with the usual blanket statements. Negotiation tactic, trade chess, licenses will be routine. But markets don't care about narratives. Markets care about shipments. And by mid-November, the physical whispers started to become a pattern. Applications were pending. Smaller exporters were being delayed. The approvals that did appear came with strings attached. Only to certain destinations, only for certain uses. Report everything quickly. In other words, not an export policy, a dial. And when someone has a dial, they eventually turn it. By late November, silver pushed through $60. People called it momentum. But momentum is what you see on the surface. Underneath, it was fear. Fear that the old system, paper sets price, physical follows, was about to flip. Then a strange thing happened right in the middle of the breakout. The major benchmark exchange in the West experienced a long trading interruption. Hours, during a historic move, during a tight delivery window. Listen carefully. Modern exchanges are built with redundancy. They're built to survive disasters. So when the system conveniently pauses at maximum stress, you should not treat it like a random sneeze. You should treat it like a pressure valve. Now zoom to early December because this is where the behavior changes from watching to front running. One of the world's largest silver-consuming markets started importing like the door was closing. Not normal restocking, not seasonal flows. Urgent buying, shipments pulled forward. Premiums paid without negotiation. Metal moved like emergency cargo. Why? Because everybody with a real factory understands one brutal truth. In a licensing regime, timing becomes the enemy. Even if approvals come, approvals take time. And time is what manufacturers don't have. Then the rumors hit the brokers, not the retail rumors, the serious ones. Orders for massive tonnage. Instructions that didn't sound like get exposure. They sounded like get bars. And the brokers did what brokers always do. They searched the usual hubs. They asked the vault networks. They asked the refiners. They asked the market makers. And the answers started to sound the same everywhere. Limited availability, long lead times, offers to substitute paper instead of metal. That's the system admitting what it tries to hide. Paper is infinite. Bars are not. Inside China, domestic demand started overheating too. Retail products tied to silver surged. Premiums detached. Regulators stepped in with pauses and caps to cool the frenzy. And that's a tell. When regulators try to cool a metal, it usually means the metal is doing the one thing they can't allow, revealing scarcity in public. Then came the signal that, historically, shows up right before a commodity market breaks: backwardation. Normally, future delivery costs a little more than delivery today because holding inventory costs money. But when the market is desperate for immediate metal, today becomes more expensive than later. That's backwardation. That's not a normal market. That's panic with paperwork. By mid-December, the Shanghai physical price was leading the dance. Future contracts cheaper than immediate delivery. The market paying extra for now because later had a question mark attached to it. And then the last week of December arrived. Silver didn't climb, it lunged. New York printed into the high 70s. Shanghai printed higher. And on December 26th, the gap widened again. $81. Now $19.99 in Shanghai physical against $79. $57 in the West. Here's what that gap actually means. It's not just demand, it's distrust. Distrust that the benchmark price can secure supply. Distrust that delivery is guaranteed. Distrust that the paper price is a real clearing price. The gap is the market's way of saying the world is turning into two prices: the paper price and the price of the thing. Now, why would China do this? Because silver is not jewelry first. Silver is conductivity first. It is the most conductive metal used at scale in modern manufacturing. It is embedded in solar. It's inside vehicles. It's inside power electronics. It's inside the hardware that makes data centers and high-end computing work. You can thrift it in some applications, but thrift has limits. Chemistry has limits. Physics has limits. If you care about dominating future industries, you do not casually export your bottlenecks. You secure them. You prioritize your domestic manufacturing. You make the world compete for leftovers. This is resource nationalism. And if you've seen it before with other strategic materials, you already know the playbook. Restrict exports, force foreign buyers into uncertainty, watch prices explode, keep your own factories fed. Now add geopolitics to the fire. Western governments have been waking up to supply chains as weapons, more materials labeled critical, more speeches about domestic production, more plans. But plans do not create ounces. New mines take years, new refineries take years, permits take years, local opposition takes years. And China doesn't need years. China already has the machinery. So January 1 isn't a fresh story. It's the moment the story becomes enforced. And here is where the silver market's architecture becomes the villain, because the global silver market is not mostly physical trade. It is mostly derivatives, paper contracts traded in volumes that dwarf the physical world, paper claims multiplied again and again because the system assumes only a small fraction will ever demand delivery. It assumes most participants will accept cash settlement. It assumes the physical market stays quiet and obedient. But when physical demand rises while physical supply becomes gated, that leverage turns into a trap. Because you can print paper claims, you cannot print bars. This is why you're seeing retail symptoms already. Dealers raising premiums, listings flipping to out of stock, pre-sales with vague ship dates. Not because demand is cute, because hedging is breaking. A dealer normally sells you metal, then hedges by shorting paper. But what happens if the market gaps violently higher on January 2nd, and your hedge becomes a loss bigger than your business? You stop selling. Or you raise premiums to cover the risk. That's not emotion, that's math. In London and other vault hubs, the stress shows up in quieter ways. Inventories drifting down, available float shrinking, borrow costs spiking. When it gets expensive to borrow silver overnight, it's not because the world suddenly loves spreadsheets. It's because the bars are harder to find. And when the float disappears, price discovery becomes theater. Now we arrive at the part you actually need, the next 4 days. Because the market is walking toward a date with low liquidity, high emotion, and a policy gate about to snap shut. December 28th is the final serious business day before the New Year shift in China's system. That means one last pull, one last wave of withdrawals, one last scramble for get it now. Us. Every industrial buyer who can pull metal will try. Every trader who understands the gate will try. And that pressure can push the Shanghai premium even higher. Then you hit December 29th and 30 in the West. Holiday desks, thin volume, fewer sellers. This is where price becomes dangerous. In a thin market, price doesn't step, it jumps. A single aggressive order can teleport the quote through multiple levels because there's no one there to offer metal at each rung. So don't be shocked if you see sudden moves that look like a glitch. They're not glitches. They're what happens when liquidity leaves the building. Then comes January 1st. The licensing regime is live. From that moment forward, exporting silver from China becomes an application, a review window, and a discretionary approval. And the scary part isn't just, will they approve? It's, how long will it take? A 30-day review clock turns a global supply chain into a waiting room, and waiting rooms shut factories down. So what happens when global markets reopen on January 2nd? The first thing traders will do is check the East. They will look at Shanghai physical pricing. If Shanghai is higher while the West was closed, Western benchmarks must chase. And when they chase, shorts get trapped. Stop losses trigger. Forced buys hit the market. And in a market already thin, forced buys don't push. They detonate. That is how you get the kind of move that changes the public's psychology. But there is a darker scenario. What if the first week of January brings delays? Not a ban, not a headline, just silence. Under review. Processing. We'll update you. If that happens, importers outside China must assume the tap is effectively off until proven otherwise, and that assumption changes behavior instantly. Industrial buyers stop negotiating price. They negotiate certainty. Solar manufacturers bid for paced supply because missing shipments means penalties. Electronics producers bid because missing components means lost cycles. And when industry starts bidding in a panic, investors pile in behind them because nothing attracts capital like a visible squeeze. Now let's talk about the companion signal, gold. Gold has been screaming too. That's not random. Gold is the stress gauge for confidence in paper promises. When gold rises and silver rises, the ratio compresses. And compressed ratios historically signal a revaluation phase in silver when the market realizes silver is not just small gold. It's a separate beast with a tighter float and heavier industrial pull. Here's the question I want you to answer in the comments, because it reveals your model of the world. Do you think the real silver price is the future screen, or the number paid for immediate delivery? And second question, do you think the gate being installed on January 1st is a temporary tactic, or the start of a long-term strategy? Drop your answers below. I read them, and they shape what we cover next. Now, what should you do? I'm not here to tell you what to buy. I'm here to tell you what's happening so you can think clearly while everyone else gets hypnotized by the ticker. If you already hold physical, understand the game that will be played in early January. Volatility is a weapon. Thin markets create flash moves. Algorithms hunt clustered stop losses. Paper can be slammed down for minutes or hours to trigger panic. That does not change the physical situation. A drop on a thin screen does not magically refill refineries. It does not reopen export flow. It does not ungate the metal. If you're holding metal, you're holding material, not a mood. If you don't hold silver and you're trying to buy, understand something brutal. Premiums are not going back to normal just because you want them to. Premiums are the price of certainty, the price of immediate possession, the price of not needing a permission slip. As the door narrows, certainty costs more. That's not hype. That's how every constrained market behaves. Now zoom out one last time, because this is bigger than silver. For decades, the world lived inside a debt-based fantasy. Promises stacked on promises, deficits normalized, printing justified, and it worked as long as confidence stayed high enough that people didn't demand the collateral. But when confidence cracks, people run to what can't be printed. Hard assets, real commodities, final settlement. Silver sits in the center of that shift because it is money to some and oxygen to industry. It has two engines of demand and one supply chain. Now that supply chain is getting gated. So here we are. Late December, a visible east-west premium, 4 days to a policy switch, and a market structure built on leverage that assumes delivery is optional. That is a recipe, not for a smooth repricing, for a violent one. Because when the world realizes the screen price can't source the bars, the screen price loses its monopoly. And once that monopoly breaks, the market doesn't politely adjust. It snaps. And there's one mechanism that could force the West to reprice, whether it wants to or not. Arbitrage. If physical in Shanghai is trading meaningfully above the Western benchmark, global traders see a spread they can't ignore. Buy where it's cheap, sell where it's dear, and pocket the difference. On paper, that sounds easy. In reality, it becomes a stampede into whatever instrument still allows access to deliverable metal. That stampede doesn't lift the price gently. It compresses time. It turns days into minutes. Because to capture the spread, traders have to buy first, and they have to buy now. And when enough of them do it at once, the benchmark exchange isn't setting the price anymore. It's chasing the price. This is how manipulation ends, not with a lawsuit, with a shortage. Now picture what happens if the East opens after a holiday and prints a higher physical price while the West was sleeping. The first bids in the West don't start at yesterday's close. They start at catch up. And catch up in a thin book becomes a gap. Gaps are psychological warfare. A gap tells every short seller, you are late, you are trapped, and you are about to pay. That's why the next 96 hours matter. Not because anyone is predicting a magic number, because the structure is fragile, and fragile structures break at the seams. Here's the cliffhanger most people won't see coming. If industrial buyers begin bidding for immediate delivery while exports are gated, the market can enter a feedback loop where every higher price triggers more urgent buying, not less. That's the opposite of what traders expect. That's why shortages are so dangerous. They don't cool themselves, they self-accelerate. So don't let a quiet holiday calendar fool you. Quiet on the outside can be violent on the inside. If you only watch one thing this week, watch delivery delays globally. They are the first domino, always, today. Because policy doesn't care about your vacation, and physics doesn't care about your portfolio. 4 days. Then the system learns what happens when a global metal gets a gate and a clock.